commentary for the 12th of January 2026. Letting you know, last week we had an audio problem, so I'm going to be making a 20-minute valuations video that we'll put into last week's commentary video, and it'll just be a short 20-minute teaching video on how to calculate valuations. Little bit of news for next week. The commentary will be held on Tuesday. Monday is Martin Luther King Day and the market is closed. So let's take a day off next January 19th, which means we'll do our webinar on Tuesday, January 20th. Okay, looking at things, we just had someone else join. If you're new to joining us tonight, we have a handout for you in the handout section, I guess. It's the 2025 valuation projections. It actually should say 2026. I hope that came across correctly. There's nothing in it. It's not one of, there we are. Yes, it is 2026. So as you save it, change it to 2026 valuation projections. That would be the smartest thing to do. And it looks like it's under the materials tab. Thank you. I run something a little bit different than you guys. So it looks like it's in the materials tab. For me, it says handouts. So it's a handout for me. It's materials for you guys. All right. I do this every year. I try to do this every year, but this is going to be a little bit different. But I want to talk about SMART goals. And I put some information here, but I also want you to use these goals not just for the stock market, but just in life. I've been a goal setter for forever. I picked it up in sports. And one of the best ways to stay on track when you're working at getting what you want to get done, it takes certain steps. So I'm just sharing with you what's worked for me in regards to how I set SMART goals. I'm relating it to the stock market, but I do the same thing in life. I've done this for starting a business, for setting the goals, how much I'm trying to do, but I'm going to relate this to you guys in regards to the stock market. And it always starts off that I get this question over and over again at the beginning of every year. What do you think the stock market will do in 2026, and what are your goals for 2026? And part of me wants to say it doesn't matter. No matter what I think, the stock market doesn't care one little bit. That's why I trade the way I trade. We had a fabulous year last year. In fact, what a year we had last year. It was really amazing. And I trade that even if I'm wrong, I can still be right down the road. And I like to call it my 2 cents when we talk about goals, because I still believe more people will lose money in 2026 as they set unrealistic goals to make unrealistic returns, trying to catch up for the last 3 years of the S&P 500 returns, or trying to catch up for last year's return. I was shocked. I'm going to go on the record saying I was shocked to find out that if you have an insurance product, and an insurance product that might be a whole life, a universal life, But if you have an insurance product, there is a better than average chance last year you broke even or lost 6.52%. Because last year the market was down 20%. For the correction, a lot of the insurance for the monies, the collateralized monies that were backing whole life, universal life, life insurance that you can borrow from, that money was converted into bonds and it missed out after 60% lost 20% of its value. Can you imagine losing 6.5% and a 16% plus return on the year? I see it all the time. Egos lose people money as fear and greed take over. There's never ever guarantees in the markets. People aren't willing to take profits because you don't go broke by taking a profit. Having a system using the collar trade where even when you're wrong, you're doing something to help protect portfolios. You're doing something that will help protect or make more money down the road with people's money. This is the importance of what we do at Hurley Investments. I'm going to have a section that describes, for those of you that are in education, I have a section that describes what type of trades are conservative safe trades, what type of trades are medium risk trades. You don't have to agree with it. You're welcome to ask me about some of these, but let's just go through a couple steps that I always like to use in SMART goal setting. The essence of SMART for me is simple, specific, and schedule it. If you have a goal that isn't simple, isn't specific, and you can't schedule how you're going to accomplish it or when you're going to accomplish it, it doesn't make sense to write it down as a goal. It's that keep it stupid, simple acronym. Decide on a specific amount. Write it down. Hold yourself accountable. I like to schedule it in a planner. I'm still old school. I carry around a planner so I can write things down, so I can scratch it out to make sure I've done it. If you're trading, you're one of those that comes from the investing side, make sure that you schedule your return over a year's period of time. And don't judge yourself on the January, the February, the March, the first quarter, the first half of the year. Make sure you're looking at your goals on a daily basis. Make sure you can schedule reasonable times and give yourself that leeway of being wrong. Believe it or not, in the stock market, it's rigged against you. You're probably going to be right about 33% of the time. What system can you use where you can still be profitable 33% of the time? The M in SMART goal setting is for measurable. A lot of people talk about pinpoint goals. I want to be a millionaire. I want a 7% return. I want this, I want that. I think a goal should have a range. Looking for a range goal. You know what? I'd like to weigh 225 pounds again. That's right in between my, well, actually it was 227 to 232 is my ideal playing weight in college. I'd like to be at 225, just a little bit skinnier. That is a pinpoint goal. A realistic goal, if I felt anywhere between 220 and 240 for my 278 that I weigh right now, that's a win for me. One of the biggest mistakes I see people do in the stock market, they want 5% each month. They want 2% each month. They set a pinpoint goal. They miss it the first month, take more risks the second month. Miss it the second month, take more risk the third month, into it starting their fourth month in the stock market, they're upside down. Think about setting a range goal. And I think some of you saw it last year. Last year, when we hit that 20% return, we pulled back and cashed in some more of the leap long calls. We put some things farther out in time. We shifted our protection to make sure the worst you would do last year would be about a 20% return. When it's measurable and it's a range goal, you can work on keeping those goals moving forward, but at the same time protecting those gains that you've already made. The A in SMART is attainable. Again, there are a lot of things that people wish they had. And if you can't make a plan on how you're going to attain your goals, again, it's a wish, it's not a goal. I always think it works best starting with the simple step of asking yourself, what do you need to do, or who do you need help with to accomplish X, Y, and Z? You're going to notice I put in there a better trader, a time trade, which that doesn't make a whole lot of sense, a stay-at-home dad, a stay-at-home mom, a millionaire. Again, too many people write down a wish list, not a goal. And if you can't find a way to attain it, then is it worth your while? And then when it comes to trading, for all you that have been through the education, I find it very interesting. A lot of people talk about how much they want to make, but how about how much are you willing to lose? How much of your portfolio be in safe collar trades versus pure option strategies versus Vegas trades versus high probability? How much margin are you going to use to attain your goals? It's figuring out the details, those small details that make those goals attainable. My R for goals: realistic and relevant. I talk to people all the time. I want to make 50% or more. And my simple answer to them is, how does it feel to want? I want to make 100% more. I want to look sexy. I want 2 houses, one on the beach and one that's in my mountains of Utah. I want. How realistic and how relevant is your goal to those things that truly will matter most? I giggle because I always want a 50% return. Is it relevant and realistic? Not every year. In real life, I don't get there a lot of the times. Maybe last year we do on some people, right? But is that 50% return realistic? It is sometimes. And will I keep working for it, or by not getting it, does it cause me to quit? If it's never going to happen and we're never going to hit that goal, even with a step-by-step progression to get there, adjust your goal. Make it more relevant, make it more realistic, make it something that you can attain. I wish more people would put smaller short-term goals in, something that's relevant and realistic that they can hit and build upon. We need to remember the S&P average after World War II starting in 1951 is only 7.74%. If you want to add dividends in there, which aren't a guarantee that you're going to receive, especially if you're shorting the market, a 7.74% return is the average return over the last 75 years, 74 years. Is a 50% return realistic? Is 10% a month realistic? Is doubling your portfolio every year realistic? Probably not. And then the T in SMART is for time. Set aside a time period to accomplish your goals. Again, it's pretty simple. Year-long goals break down into quarterly goals, break into monthly goals, break into weekly goals. Find a way to make it work in certain time periods so you can build on your successes, so you can get the support if you're failing. I like reading the last sentence. Whether it's between you and your spouse, your kids, your parents, your education programmer, or maybe the good Lord himself, find support during the tough times, and I promise you that your success can come. It will come if you follow these steps and apply these steps, or these principles. Actually, they're not really steps, they're principles to your goal setting. And it's pretty neat when your goals turn from a wish to an attainable goal. A lot of times people ask me, well, what do you think about this or that? When it comes to trading, it's pretty simple. Conservative trades, perhaps 70% of your portfolio, can be cash or T-bills, caller trades, protective puts, covered calls with long puts, which is again a caller trade. But I like the deep in the money for the covered calls. Owning equities where you can make a mistake and still find a way to be profitable. Medium risk trades, I usually use the rule, maybe 20% of your trades. Bull puts, put calendars, call calendars, strangle straddles, puts or call back spread ratios, wing spread, bull call standard application, bull calls for leaps, bear calls, bear puts standard application, and bear calls for leaps. I like the typical strangle straddle. It's not such a volatility play. Obviously, bear calls are in there. It's finding those option spreads. And then high risk trades, which are perhaps 10% or less of your portfolio, straight long calls or long puts. It's a non-hedge directional trade. It's your 1 out of 3 chance of being right. A naked short put, naked short calls. We'll never do this. It's not a trade you should be willing to do unless you're willing to lose everything. And it really can't be a 10% or less position in your portfolio. Vegas trades are outside of the box. As we were looking at what we want to be in, our new positions that we're looking to get into are Key Corp, Boeing. We are hesitant on BSX, and we're hesitant on Ford. But those are some of what we are looking at. And yeah, of course, that makes a lot of sense. BSX is Boston Scientific Corp. We still like some of our favorites at Apple, Google, Meta, Disney, and Ford, but we haven't been in Ford for a while. Boeing and Under Armour are wild cards. We are also looking at some of the ETFs for the smaller accounts. And in those ETFs this year, we're going to pull out technology, and we're putting JEPI in there and Income Realty, which will take the place of the IVB. IVB just can't get to where it needs to go. Now, we're going to go over more of this next week. And we're still looking at some of these positions, but we'll look at it next week, and we're going to talk more about how we're looking to position ourselves and some of these things that we've had such big runs in. Notice in here, we don't have Micron or NVIDIA. I really would replace Ford and put NVIDIA into this one, but we are still looking at Micron and Palantir. In fact, boy, I'd hate to say it, but I would, the wild cards are wild cards. And it's been a while since we've been in Under Armour, but it's looking like it has a big opportunity this year. Talking about 2026. Midterms, right? Yes, no? Let's see if I've got that right as I'm thinking about that. Their midterm 2026. Of course. Elections are scheduled November 3rd, 2026. I should have done a better job about that. Election year, midterms, November 3rd, 2026. It's interesting because I put in a quick little chart here of where some of the big guys see our market going to. If you put in Hurley Investments, we're going to be right here in the middle, right between Citigroup and Goldman Sachs. We're looking at a 76.80. And a couple of people asked, Kevin, how did you come up with that? What were you using? Where did that number come from? How did you calculate it? Because I did not give it an explanation when we were doing the own valuations, which is interesting because I took Goldman Sachs earnings of $306 for the S&P 500 for 2026. Goldman Sachs seems to have been the one that's been more accurate to the actual earnings of the S&P than any of these other banks that are out there. Then, instead of using the 31% PE ratio, I just came up with a 25. Yes, historically 17 to 19 is where it's been. Right now we're above a 31% PE on the S&P 500. I think that's changed. I think the PE standard PE ratio is much higher than a 17 to 19% PE because there's more technology, because we've flooded the system with money. If you take 25 times $306 of S&P 500 earnings, you come up with 76.50. Kevin, that's not 76.80. I added in a 30-point buffer because I want to. That is how I came up with 76.80 as the S&P 500 ending value going into next year. And that roughly was about an 11-12% gain in the year. I also would say we're probably going to have a pullback or correction. It seems like we're going to lose 10 to 20%. It's a self-inflicted pullback because people want to see it. It wouldn't surprise me after our earnings, before or during the sell-off for taxes. We have a self-prophesied, hey, we need a pullback, so the market's going to sell some things off. All right. Earnings are coming up. We're in our first week of bank earnings. Here's our list of earnings, what we're paying attention to. We do not have Bank of America in here, even though it is reporting earnings on Wednesday. We are looking at getting rid of our Bank of America stock, having it called away at roughly $58.40. We have a deep in the money covered call. We do not see the growth in Bank of America, so we're getting out. The big picture I did not check on, but here we go. Dow Jones Industrial Average. A couple of you have asked about this chart. Stockcharts.com. We use the 5 and the 200 day because that's what big money uses. No one that's trading anything of any importance is using a 9-day, a 9-week, a 100-day, a 59-day. We just don't do that. We set up our charts. In fact, someone asked if I could go over that really quickly. I probably should. Pretty simple. We stockcharts.com. I should probably log out. If you just entered a symbol like micron, this chart comes up. For us, we normally go down to 6 months. We don't care about a whole year. And there are a couple changes we make. Chart size, my eyes are getting bad. I like a landscape. Color scheme, I use color vision impaired because I'm colorblind. Exponential moving averages, I actually dump that and get rid of it. But I do like pivot points in here. So I find pivot points, which is right there. For indicators, I don't care about price performance or volume. I just want a simple MACD. And because I used it for forever, I always put in a Williams %R. A Williams %R give me the understanding of a medium stochastics. When I update my chart, it's going to look something like this, and I'm really good to go. A keep it simple, stupid kind of chart is what I'm looking for. 6 months out in time, I'm looking for the most important points for me. Why? There they are. Why do I use pivot points? I use pivot points because that's in relation to the idea of less time is more accurate, following group mentality. Pivot points are 30-day volume positions. It's just like using, looking at options for stock movements. We're following the herd mentality on where those positions are going to. Why do I use a Williams %R? I use it because it helps me when I'm in between a decision, when things are flat on a MACD, when I'm not sure if a trend's going to continue forward. I like to see where big money's putting their money. That's what a Williams %R does for me. Would I ever use an Ikumoku? No. I am American. So I will do Wagyu beef, but I'm a beef and potatoes. I'm just kidding there, Abraham. Yes, I would. Short answer is yes. And Bill Brander, do I use an RSI? I do. I don't have any idea. I thought that was up there at the top and I could not find it, but yes, I still use the RSI. And, you know, in my head, I'm looking at where the heck did my RSI go? Do you use an RSI? It's interesting. My charts usually look like this. RSI you find down in the indicators. So my charts mostly look like this. This is what I pulled out for you. But again, I'm really looking for simplicity. I don't want to be so looking at so many indicators that I get paralysis by overanalysis. Keep it simple, stupid. Do I use a 9 in a 20 day and 15 in a 30 for short term? I don't. I'm more interested in what big money is. Those pivot points give you those same indicators for a 9 and a 20 day crossover, a 15 day and a 30 day crossover. Again, I'm looking for bigger returns than just an options 20% cash out, get out. But Dow Jones Industrial Average, bullish going into the year. Pretty good start to the year, I must admit. S.M.P. 500. We have a bullish S.M.P. 500 going into earnings. Pretty good bullish run into the year. Testing 7,000. Love it. Earnings can push it higher going into the next couple weeks. NASDAQ, pretty nice bullish, literally bounced off of the 50-day for both the S&P 500 and the NASDAQ. Look at how much room on an RSI we have to run up till we get overbought. Love the NASDAQ composite running and running pretty good. S&P World End January 2026. I'm sticking with 3%. Earnings, Delta Airlines, JP Morgan on Tuesday, Citi, Wells Fargo, Bank of America, and Fuller on Wednesday. Thursday, First Horizon National, Goldman Sachs, Morgan Stanley, PNC on Friday. First week of the bank earnings. Tomorrow we have CPIs. On Wednesday we have retail sales and PPI numbers. Thursday, initial and continuing claims, and Friday, nothing that really sticks out. Industrial production might run our futures, but it probably shouldn't. And that's not an M, that should be an N. NAHB Housing Market Index. Yes, there are some other economic reports there, but not really anything that I think will move our futures. All right, questions, you guys go ahead and get ready for questions. I've got a little bit that I found interesting. Advisors see a double-digit equity gains in 2026 with a bumpy ride. These are more projections. Projections of where other people feel the S&P 500 might go to. It doesn't really matter. Herd mentality will take over when herd mentality takes over. Silver's on a run. There have been rumors that Citibank is short 252 ounces or metric ounces. Not necessarily true. I have an interesting article on silver, but boy, silver's running. Silver's running. I might be a little surprised if it gets up to 100. It would definitely be overpriced at that point. It's just something that's running right now. It's trading right now at, I'll tell you, silver, $83.90. It looks like $83.91. It's down $1.20, so it got up to 85. It definitely is overpriced. It has been shorted by some banks. There are some shorts on silver right now that have to get filled, but because those usually come out quarter to quarter, the fact that silver's run up so fast and so high, yes, I think they're being covered or have been covered. But here's a very interesting article. No, Citi is not off 275 million ounces of silver. It's an interesting article on how silver trades short and long, day in and day out. Interesting article, Apple picks Google's Gemini to run AI-powered Siri coming this year. Apple is behind the race on artificial intelligence. And Alphabet today hit a $4 trillion market capitalization. Welcome to the $4 trillion club for NVIDIA. And then an interesting short article on Palantir. Again, it's one of our breakout stocks for the year, but it is definitely, it's more of a risky one. It does not have the fundamentals that we would look for. So it's a breakout stock. We've been trading that one just with covered calls and levels of support and resistance and doing pretty darn good with it year to date. Okay, with that said, any questions you guys have for me? Are there any questions you guys would like to ask me going into this year that I can do the best I can? Some of you actually asked a couple questions there. Someone asked, I use the Ikimodu. Some of you have asked on a couple others why I'm not using on balance volume, et cetera, et cetera. I just have not found those technical indicators to be of use. If you have found them to be useful, trade them as you can. For me, simpler is easier. Yeah, I mean, I've gone through a lot of indicators in the past, and it's just not a benefit to me. So that's why I don't use Ikimodu, on balance volume. It's funny because someone always talks about you got to have an edge. You got to have an edge. This is the indicator for the edge. In real life, the edge is what do you do when you're wrong, and how do you still turn that into a profitability position or a profitable position? That's the edge. That's what matters. Where can I find a way to technically make a mistake, technically use your best educated decision and find out that you're wrong? Where can you find a way to be wrong but still be right in the longer term? That's what I'm looking for. Any interest in a rare earth position? I have done FCX in the past. I could not get the numbers to work for me on FCX this year. I'm going to show that I'm going to show that in that valuation video that I tried to do. It just, I'm looking at FCX. The stock price was 51.63. It could have a target price of 78.75, but it has a target low of $32. I thought about SLV. You know, we've been in the past. We got out, I think, for you guys around 55. Silver is so overvalued right now in gold that I'm worried even the miners, even the indexes, even those that are using the rare earth minerals, there's got to be a bit of a pullback, and it can be pretty significant. So I'm not able to wrap my head around a rare earth position in minerals at this time in accounts. Really, the honest answer is that's a very speculative play. It's like a commodity, and trading a commodity, really what matters most is weather and natural disasters. And if you're trading on weather and natural disasters as your indicators for growth, really, really, really hard to do. It's very difficult. So hopefully that answers your question on the rare earth position. Besides, with a little bit of luck, the United States will own Greenland, and it won't matter because we'll have plenty to last us well into the future. Come on, I thought that was a little funny. All right, Could you tell us your thought process on when you apply puts to a position? Is this primarily a technically driven decision? So no, Nathan, I have learned that there is a chance that a stock will lose anywhere from 15 to 38, I don't remember the number, but 38% plus of its value. There's an 83% chance that will happen during an earnings event, meaning 2 weeks before and up to 4 weeks after. So playing the probabilities, a position will most likely lose upwards to 15 to 38% of its value at that earnings event. So my technical trigger for applying puts is anywhere from two weeks to a week before earnings and going out 4 weeks after. Probably farther, because I don't want time value to deteriorate too fast, but my trigger for puts is earnings. Now, if we have technical crossovers on the stock, a news-driven event, a firing of a CEO, wars and so forth, technical drops on crossovers on a stock or the indexes also will trigger puts. But primarily puts are triggered by an earnings event when a stock 83% of the time will most likely lose somewhere between 15 to 38% of its value. So that is my trigger on when I'm putting puts on. Let me know if that answers your question there for you. And I don't see any other questions coming in. Appreciate it, Nathan. Thank you. All right, guys. Hey, pleasure seeing you. We'll end this tonight. I will see you guys next Tuesday. Monday is Martin Luther King Day. It's a day off. Market's closed. So we'll push our commentaries one day until Tuesday. Guys, take care. Have a wonderful evening. Appreciate you being here, and look for that valuation. It'll be, again, a 20-minute video, short educational video on how I calculate these valuations. Everything got jumbled up last week, so I'm going to have that available both as a separate little YouTube video and to fill in for last week's video that got messed up. All right, guys. Hey, look forward to seeing you next week. Have a wonderful week. Great start to a year. And I look forward to talking to you then. Bye-bye, everyone.